Okay, let's see. I just have to make sure we are officially live. I'm on TradingView streams. And we are live, ladies and gentlemen, episode number 10 of the TradingView Show. And I am pleased to welcome Sean McLaughlin. First of all, Sean and I go back many years together, potentially 10 years. He was a mentor to me at a certain point early in my career, and he is an options trader by heart. And I can tell you, I'm 10 years into markets now, and I still don't know that much about options, which is why I'm happy to have him here so he can educate me for the, third or fourth or fifth straight year of me trying to understand options. So today, Sean is the chief options strategist for All Star Charts. He began his career in 1998 at a trading firm in Tampa, Florida, which we're going to have to talk about because that means Sean was trading the dot-com bubble. And for those who know the dot-com bubble, there are tons of lessons there today. Sean also launched a small hedge fund with a handful of investors to educate a trend following strategy, which we're also going to have to talk about because Sean was the one who introduced me to the turtle traders, I just realized, and I want to hear his opinion on that. So without further ado, Sean, great to have you on the show. I have an idea of where we're going to begin because I want to hear about your background. Tell us about those days in 1998 and how you got started, because that's so cool for people who don't know.
Well, I got started kind of by accident. My first job out of college, I worked for MetLife selling mutual funds. But that whetted my interest in the stock market. And I quit that job after 6 months because selling mutual funds when you're a newly college graduate is a terrible job, which I learned the hard way. But I ended up moving to Florida. My dad lived in Florida, and I got a job at it's kind of embarrassing to say, but it was a job that is basically a boiler room, but not a boiler room the way you think of boilers. Like if you've seen the movie Boiler Room, or if you've seen The Wolf of Wall Street, that's a true boiler room, right? Where people were pitching stocks to doctors and lawyers and anyone they can get a phone number for. We weren't quite doing that. We were one level removed. We were pitching penny stocks, but we were pitching them to actual stock brokers. We were calling the stockbrokers and trying to get the stockbrokers to get their customers into these dodgy penny stocks. I was 21 years old at the time. I didn't know anything. I didn't know this was legal or illegal or whatnot, but it didn't feel right after a while. But anyway, that's neither here nor there. The important part of that story is that while working at this firm, I became really good friends with another guy who kind of sat next to me at my desk, and he was very interested in day trading. And he had found out that there was a trading firm, a trading office. This is the late 90s, and trading arcades, as they were called, were kind of popping up everywhere at that time. And he found out there was an office literally 2 buildings down from where we were working. And so one day on our lunch break, we walked over to this office, unannounced. We just, opened up the door of this office. We went in, and we found ourselves in a room where there were a bunch of guys staring at computer screens, about 20 people in there. And we opened that door and walked in the room and stood there for what felt like 5 minutes, but it was probably just 30 seconds. But finally, somebody looked at us and said, "Can we help you?" And my friend's like, "Yeah, is this you guys trade stocks here?" And the guy's like, "Oh yeah, I know who you need to talk to. 1 second." He went and found somebody in another room, and the guy came over, introduced himself, and basically said, "Oh, you guys are interested in trading? Great. Here's a couple computers. Why don't you sit down here? It's a demo system. Here's the buy button. Here's the sell button. You guys play around and see how it feels." And we're like, "Okay." And we were banging keys, hitting buttons, and lo and behold, wow, we were making money on this fake trading thing. And we're like, this was really cool. And for me, it was just fun and games. But my friend actually really did want to day trade. He knew a little bit about it, and so he was like, "I'm going to do this." After one day, he's like, "I'm doing this." And so we talked to the owner of the office, and we asked how do we get involved? He said, "Well, yeah, everyone here trades their own money. They bring the money here, and we give you leverage on the money. We give you cheap commissions." And this is the late 90s, right? So one of their benefits was we have fast internet, which at the time, fast internet was not something that people had. right? It was, some people had it. It was very expensive, but most people at home had dial-up internet service, right? So the fact that they had what at that time was called a T1 internet speed line was, game changing. So it turns out you needed 50 grand to open an account. And, I pulled my wallet out of my pocket and I said, well, this is the $5 I have to my name. So I'm out. But my friend actually did have 50K. He was married young, and his wife had been in a car accident recently. She's totally fine. She was fine, but they had won a lawsuit, and so he had some money, and it was burning a hole in his pocket. And so my friend's like, I'm going to do this, but I couldn't because I didn't have any money. But it was going to be like a 2-week process for my friend to get his account opened at this firm. So the guy that ran the place said, "Oh, you guys are welcome to come back every day and play around on the demo." And my friend Kenny, like, you can learn how it's done. And Sean, you're welcome to hang out and play around. So that's what we did every day for 2 weeks. We went to this trading firm on our lunch break from our crappy job and played on the demo. And after about a week of me going back every day with my friend, and he was getting close to having his account open, and he was going to, start trading there full time. The owner comes back to me and he said, "Hey, Sean, you've been coming here every day. You seem like a really smart guy. You seem like you're into this kind of thing." He's like, "What if I told you I knew somebody who would put up 50 grand for you to trade and you would just split the profits with them 50-50?" And I was like, "I'll start tomorrow." And so that's how I got started. That was my intro into trading, and it just happened to be really the beginning of that blow off .com bubble that you got there on the screen right now. This was July 1998 when I started, and boy, it turned out to be quite a wild ride. Actually, this is kind of perfect that you have this time frame right here, because this actually almost fully encapsulates the time that I was a day trader at this firm. I started in July of 1998, and I was there until just about the end of 2002. So this chart actually
That's awesome.
almost perfectly charts my time at that office. That's great.
That's great. I want to actually go back to the comments you made about just working at sort of dodgy firms, because I think that is important, and I find that it's come up actually a lot in these shows, which is important to talk about, because markets often get people because of this sort of like, hey, it's so easy to accumulate wealth here. It's all honest, hardworking people, trading equities or trading crypto. But you kind of have to peel the Band-Aid off and realize, like, actually, there are sort of these sides of the market that, people should know about, so they don't approach it so loosely, you could say, or just start throwing money at it, because it's not like that. You really don't know what's going on behind the scenes, and you want to make sure you're doing research, you have a plan. So curious if you've ever reflected on that, like, even though that was a dodgy firm, when you look back on it, it's almost maybe a good thing that you saw that side so you could avoid it into the future.
Well, look, the reason why we were all there in the first place, it was the allure of making a lot of money, right? It was the hope, it was the promise. Now, to the firm's credit that I worked at, they never made any promises that, like, hey, you're going to be a millionaire or you're going to make X amount of dollars a month. I mean, they were pretty straightforward that this is hard. Look, this is hard. Not everybody makes it. They were pretty upfront about that. So to their credit, good on them. What's hilarious when I think back on it is that when I was there, when I started, there were maybe 20 people in the office. It eventually peaked out at about 40 traders in that office, mostly men. There were a couple of girls in there. We were all, with the exception of a couple people, we were all in our 20s. We were all young. And the hilarious part is that none of us had any Wall Street experience. Not even the guy who ran the firm. Like, nobody had any Wall Street experience or trading experience. We were all newbies. We were all learning together. We were all teaching each other, which is good on one hand and bad on the other, right? It's just, I look back at that, and like, man, that's crazy. I can't believe that actually flew. But hey, we had guys in that office in their 20s, and girls at that time, who were making ridiculous amounts of money. Like, it was ridiculous. I was the low man on the totem pole. Like by the time I started figuring it out and making money, I was making my good months, I was making 10, 15, 20 grand a month, which is great. I mean, that's ridiculous money, especially for a kid in his 20s in 1999, right?
Wow, inflation
But
adjusted. That's
yeah,
incredible.
but I was like the small guy. There were kids in my office making 100 grand a month, 200 grand a month on the regular, and it was just an insane time. And I was actually talking about this today with some of my coworkers at All Star Charts about how somebody mentioned like, oh, these AI stocks. This is this is like the dot-com bubble, and I was like, whoa, 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 no, 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 no. Time out. The dot-com bubble is nothing like we've never seen anything like it. The only thing that came sort of close, but not even in the same ballpark, but came close was the crypto stocks mania of about 2 years ago when cryptocurrencies were going crazy. But the dot-com bubble, Stefan, you were a baby when this was happening, so you
Yeah,
have no context.
I think I was like
But
10 years old, maybe 9 years old.
yeah, I could tell you in the late 90s, at that time, you couldn't go anywhere without people talking to you about the stock market. You couldn't go to a dinner, you couldn't go to a family outing, you couldn't go to a racetrack, you couldn't go to the deli around the corner. Everybody wanted to talk about the stock market. Everybody was trading. People who had no business trading. This was in the beginning days of E-Trade, and Daytech Online was the other online thing. TD Ameritrade had just started. Everybody was opening stock trading accounts online. This was the new thing. And everybody was buying internet stocks, and you could not escape the conversation. Now, I know crypto had its moment a couple of years ago where, it was, high on the minds of a lot of people. But dude, everybody was not only talking about internet stocks, but everybody was trading internet stocks. Most people, of course, losing money doing it, but everyone was in on it. And we haven't seen anything like that since. We might see it again someday. Who knows? I hope we do. It was a fun time, but man, it was something else.
Can we just because one reason why I think I love hearing about the dot-com bubble so much is because I wasn't there, so I'm just trying to imagine what it was like, and I imagine people watching this show, lots of new traders or investors who've gotten started maybe in the last few years, also have no idea what it's like or what it was like. Can you just sort of illustrate some of the moves, like what type of percentage moves were happening in some of these dot-com stocks?
Yeah, that's a good question. So stocks like the big stocks of the day that were the real movers were Yahoo, eBay, AOL, Cisco, Intel at the time, WorldCom, which is no longer. These stocks were crazy movers. Like, for example, Yahoo was trading at, split adjusted. I think it was trading at like $400 a share, and it would have $100 moves intraday every day. And, as day traders, that was unbelievable. We were trading typically in 1,000 share lots, right? So if you bought 1,000 shares and it went up $1, you made $1,000. If a stock's moving $100 in a day, you can imagine how much opportunity. And now, of course, there's the downside of that, right? There's the sharp edge of the sword. You can get ripped by the same amount. And that certainly happened. But there were people, there were stocks that were just trading 20, 30, $40 moves intraday, just every single day. And it was unbelievable. You got a chart there of eBay. You can see it. You're showing in percentage terms. Those percentage terms are ridiculous. Look at that.
That's essentially a few months or a few weeks, depending on your starting point. And yeah, that's 1,100% really at the top. And that's from its IPO. So that is remarkable.
Yeah. And, the rules of the market have changed, right? We were primarily trading NASDAQ stocks at the time, and the structure of the NASDAQ stock market was different at the time. If you go to any NASDAQ stock now, or any stock really, and you look at what's called a level 2 screen, that shows you all the bids and all the offers, right? Today, if you look at that, all that shows you is just exchanges, right? Instinet, Arca, I don't know, NYSE. I don't even know what the ones are, but they're all exchanges. They're anonymous exchanges, and what you see there is basically fake volume or fake size, right? It'll show that there's 10,000 shares on the bid at a certain exchange, but there's way more behind it. But that's just what the machines show you now. Back then in the late 90s, the level two is different. The level two actually showed you who was on the offer and who was on the bid. You would see Goldman Sachs, Merrill Lynch, Bear Stearns, you know, the list goes on. There were hundreds of market making firms. You saw who the market making firm was at each level. You saw true size of how much they were willing to buy or sell, whether it was 100 shares, 1,000 shares, or a million shares. You would see all of that there. And that was very, very useful information for us. We would trade against that. Back then the spreads were a minimum. They were traded in fractions. So the smallest fraction was a 16th. We called it a teeny. And a 16th is 6.5 cents. So the minimum difference between the bid and the ask was 6.5 cents. Okay. Now that may not sound a lot, but we were trading at 1,000 shares a clip every trade. So if you made 6.5 cents on 1,000 shares, that was $65, and you could make that pretty quickly. And just one example of what we would do using that level two is we would see that, we've been watching a stock and we might see that Goldman Sachs is on the bid trying to buy 1 million shares, right? Every time the price comes down to their bid, they're just sitting there. Everyone's hitting them, but they're not budging. They're buying everything, right? They're sponging it up. Fine, great. So what we would do is we would put an offer in or a bid in at the same price as Goldman Sachs. And when we would get filled, we'd be like, okay, great. I'm going to either offer it out at a 16th higher. So the next person that wants to buy is going to buy it from me, and I'll make my quick $62. And I know that I've got Goldman Sachs on the bid willing to buy 1 million shares. So worst case scenario, if I think this thing's going lower, I'll just hit Goldman and get out for a scratch. I didn't lose anything. But so it was called scalping, right? We would just go back and forth and capture that spread 1,000 shares at a time, making $60, $120 every time. And we would do that, multiple times every few minutes, right? It was like, that was our game. And it was a very profitable game for a little while until the market makers got ganged up and changed the rules on us.
I have to say, that is so cool to hear that you could see who you were trading against. I did not know
Yeah.
that ever existed. Whenever I've used level two, like you said, that's really all I'm used to. I just see the exchange and maybe the size of the trade. But wow, knowing who you're trading with or against, I actually find would be really exciting, because then I could say things like, I'm on the side of Goldman on this one, and you could kind of see your trade playing with them.
Oh, and we would do
I wish
that
they
all the
brought that
time.
back.
We would do that all the time. Like I said, we were in an office with like 40 guys, and we would all be shouting out, Merrill Lynch is on the bid of Yahoo, and Bear Stearns is selling WorldCom, and everybody would kind of help each other out, and we knew who the axe was in each stock. Like, it was always a different player, right? Like Goldman might be big in this stock, and Bank of America might be big in this stock, and I forget all the players now, but there were probably 50 market makers that were active players, and we got to know which ones were in charge of which stocks.
Do you have, I have some questions that I want to stick to about maybe lessons from the dot-com bubble, and even take that to trend following. But I just want to ask, because I think it's a popular topic. Do you have any opinion on the way things are going in markets? So like, for example, you can no longer see you can't see any data about who's actually on the bid or the ask. Do you have an opinion about that? Do you think it should be more transparent, or are you sort of, now that you're an options trader, you've moved on from that type of opinion?
Yeah, I'm not day trading stocks anymore, and part of the reason is because of that change. If that change never happened, I might still be day trading stocks. Who knows? Um, I don't like it. I mean, like I said, I don't trade it now, but I definitely have an opinion on it. I hate the way the market structure is now. I think it's definitely tilted away from being friendly towards retail traders, and it's all this, like, the players can obfuscate how many, what their true sizes, what their true intentions are. They're hiding behind the anonymity of trading on an exchange. And then that's opened up the whole world for dark pools and all these hidden volumes. I mean, no, it's a totally different game than when I was playing it in the late 90s. And, I don't like it, but that's just me being a grumpy old man.
I'm right there with you. I would love to see more transparency in that regard, and I think it would actually just be more, even a little more trustworthy to a degree to actually know who's participating. Just a name, right? Just something to let you know, like, who's on the other side of the trade or who's with you on the trade. I would find that to be very interesting and helpful. So, how about options trading after the dot-com bubble? When does options come into your life? And for everyone listening, if they don't know options, I'm sort of right there with you. I've only dabbled in options in my career, so I may ask some beginner questions, but it's a fascinating market. There's much more than just buying and selling. So tell us about how you got started in options trading.
You and I over the years have chatted about this, and for me, the gateway drug to options trading, and I think this is the gateway drug for most people, is the concept of covered calls, right? Like selling calls against long stock, right? That's the gateway drug. It has an appeal. People like, oh, I could get paid to hold my stock. Great, tell me more. And that was kind of my first entry to it. I had read a book about it, and I was like, oh, this is really cool. Didn't really do a whole lot of it, but it caught my interest. Later on, while I was trading at that firm, one of the fellow traders that I was really good friends with, he had started trading with a new trading platform called Thinkorswim. It was brand new at the time. I think they launched in like 2002. And he started learning about selling iron condors and things like that. And I was like, wait, I can make money when a stock or an index goes sideways and doesn't do anything. That's interesting. And so probably where I first really got active with options trading was learning how to sell iron condors, which are basically those are what's called a delta neutral play, right? Like you don't really have an opinion on which way the market's going to go. You just hope it doesn't go too far in either one direction, and then you have the ability to make money. And I thought that was a really cool concept, and so I really started looking into that. I took a detour from stock trading and got into commodities before I really went hardcore into options. That didn't happen until later. But yeah, options have always, here's the thing about options that really probably grabbed my attention. I mean, the idea that I could collect premium, get paid when the market doesn't do anything, that was maybe the first interest to me. But really what grabbed my attention, what really got me wanting to do a lot more options trading was the fact that with options trading, I can very clearly define my risk. Now, there are certainly strategies you could trade that have undefined risk, like selling naked calls or selling naked puts. That's you expose yourself to the risk of undefined risk. But there's a lot of ways that you could define your risks very clearly. And the simplest way is just, if you're bullish, you buy a call. If you're bearish, you buy a put. And the most you can lose is the premium you pay for that option. And, you and I talked recently about, keeping options trading simple, which is something I love to do. I understand many of the complicated option strategies, not all of them, but I understand many of them and I can do them, and I do them from time to time. But all things being equal, I'm always going to default to the easiest, simplest strategy to execute my thesis because Stefan, I'm a simpleton. You know this about me. I like to keep things simple. I don't want to overcomplicate things. When I overcomplicate things, that's when mistakes happen.
Can I quickly say something about that actually?
Yeah.
You are the one who really got me started on the noise of markets and how you like to eliminate noise from your process to keep things really simple, clean news flow, clean information, less clutter in your Twitter feed, less clutter on the chart. So I just want to say, yeah, I'm well aware of your desire to keep things simple. And with options, that I feel like risk management, defining your risk in options is so interesting. To me, that keeps things incredibly simple, right?
Yeah, I had a conversation with a fellow trader, a friend of mine here where I live in Colorado recently. He's a stock trader, and he's been a stock day trader for a long time. But he just recently, I can't take credit for it. I did not turn him into this, but we started talking about it because he just started experimenting with it. Is he started trading short dated, like weekly expiration options in the stocks that he trades. So he trades all the big names that like Nvidia, like Apple, like Amazon, like Tesla, like all the big names, right? And those big names all have very liquid options markets. And he came to me one day recently and he said, Sean, I know you're an options guy, and I just started experimenting with trading options instead of stock. He's like, I'm still trading the underlyings the same way. Like I'm still, keying off the same chart patterns. I'm still getting in at the same time that I would if I was buying stock. But instead of buying, 500 shares of stock, I'm going to buy 5 options contracts, which equals you control 500 shares of stock, right? I'm buying 5 contracts. But if I'm bullish, I'm buying 5 calls. I'm buying them slightly in the money. And the benefit that he has found is that he can enter the same trade tying up less capital, right? He has the peace of mind of knowing that the absolute most he can lose is the premium he paid on those calls. But he's managing his risk. He's watching the market very closely. So he's not so worried about suffering 100% loss. But more importantly, he found that, like, let's just do an apples comparison. Let's say he's buying a stock that's trading at $100, right? And his stop loss, these are broad numbers, so this is not going to make sense in the real world, but just for illustrative purposes, let's say he buys the stock at $100 and his stop loss is at 95. Like he's looking at the chart, he sees a pattern he likes, he wants to buy a breakout above $100 and his stop is at 95. So if he buys the stock and the stock doesn't work out and it falls back to 95, well, he just lost $500. Let's say he bought 100 shares, right? He just lost $500. Fine. But if he did the same trade with options and he bought, when the stock broke above 100, he bought the 95 strike call, which is where his stop is, right? If he bought the 95 strike call, he might have paid $7 for it. Let's make up numbers here. So he bought he paid $7 for it. And then if the stock falls down to 95, which is where his stop is, he's going to sell those calls and get out, and he'll probably sell them for $3.50, maybe $4. So those calls that he paid $7 for, he gets out for $4. He lost $3. Now, remember, that same trade with stock, he lost $5. But with options, he only lost $3. So he lost less money. But let's do the rosy scenario where the trade worked and the stock that he bought at 100 goes up to 110, right? Well, that stock went up to 110. If he owned stock, he earned $10 a share. Great. If he bought those 95 calls that he paid $7 for, well, those calls are going to now be worth $15. So he made $8, right, versus 10, but he had far less risk. He almost made as much as the stock, but he had less risk. So, and I'm just making these numbers up, but he was telling me that what he has found is by trading these short-term options that don't have a whole lot of theta decay, meaning that there's not much premium left in them because they're close to expiration, and he's buying them in the money. He has found that his wins are still more or less the same size-wise, but his losses are significantly less due to the fact that he's trading the options and because there's premium that he's selling into when he gets out, and that cushions the blow when he's losing. I just realized as I'm saying this, Stefan, that I went into this trying to be very simple, and all of a sudden I started dropping all these complicated terms. So for the beginners out there, I apologize, but if you want me to explain anything, I can.
Well, I think the beauty of that, though, actually is I think the complication of options is sometimes what makes it so interesting to people, because it's such a puzzle to figure out. I'd say the other really interesting thing about options is, and you and I spoke about this just not long ago, was most new traders or investors show up and, like, the one thing everyone thinks is you press buy and then you hope it goes up and you press sell. And that's sort of 99% of the way new people think about markets. But there really is this whole other side of the market, options trading, which gives you, I don't know how many possibilities there are way to trade options or to set up different trades, but there's a lot, and I think it's fascinating that if you want to go a little deeper into markets or find something where there's an opportunity to define your risk, as you were saying, or get the leverage, it's there for you, and it might really suit your style better, which is so interesting because, correct me if I'm wrong, but with options you can define your risk. You have less amount of money on the line, but you have that leverage component, which I think is kind of attractive if you ever manage to hit a big one out of the park. Whereas with equities, I don't think that same type of win can be had. Am I wrong in the way I phrase that, or?
No, you're right. Options do provide leverage, which of course is a double-edged sword. You could lever up if you want to, and get a much bigger win than you would have if you had just bought stock. However, then you expose yourself to the risk of a much larger loss. So, um, if you're going to use leverage, do it carefully. But to keep things simple, for if you're a stock day trader and you buy 100 shares at a clip, that's kind of like your trade size. You might want to experiment with trading call options. Like if you're bullish, you just buy one call option, and play around with that and see how that changes the wins and the losses for you. I think that you will find that your wins will, add up and compare very favorably to your stock wins, but your losses will be smaller in many cases. And look, even if it's just a little bit smaller, over time, that adds up, and it can add up very significantly.
And going back to, before we go any deeper into options, something that I was thinking about and I just kept a mental note of that I did want to touch up on was, so now in your career, and for people who are just joining the show and listening, Sean's been in the market for 20 plus years, and he's been a day trader. He's seen the dot-com bubble. He's now chief options strategist. But in the middle, there was a commodities aspect that you mentioned and trend following. So this is now a different side of markets, but I just want to get back to your story. Before we move on to any other, go deeper into options, tell us about that part of your story and especially the trend following component.
Well, first of all, I love the way you say strategist, a chief options strategist. That's wonderful. Anyway, okay, so commodities.
My
So
colleague
I
is
got it.
also laughing. For those who aren't able to watch the show, they're doing the podcast format. My colleague is behind, sharing a laugh at that.
I saw Pierce walking back there. What's up, Pierce? All right, so commodity. So when I left stock trading in 2000, I think it was 2002, I left because I got really interested in commodities trading. I went deep down the rabbit hole of the whole story of the turtle traders. A friend of mine, fellow trader, had learned about it, and he, shared a website with me that turned me on. It had a whole lot of information and background about the story and the individuals who were involved. And I found it fascinating. The whole concept of trend following just made a whole lot of sense to me, just conceptual. And I was fascinated by it. And commodities it seemed like the best instrument to try that with, at least to me at the time. And so I spent a lot of time building models, back testing strategies. And I eventually ended up launching a small hedge fund where I raised money from five other investors, and started a hedge fund utilizing trend following strategies in the commodities market. So I see you got corn up on the screen. We were trading corn. I was trading soybeans. I was trading crude oil. I was trading natural gas. I was trading the currency futures, T-bond futures, like everything. And it was really, it was really a concept that made a lot of sense to me. And side note, fast forwarding to today, I have the very unique honor of having to get to meet and get to know and even consider a friend one of those original turtles, Jerry Parker. It's interesting about Jerry Parker is that he. I'm not going to go deep into the turtle story here,
Oh,
guys. If you
we
want
can't.
to,
No, Sean, but can we though? Because it's such a cool story, I think, and it kind of ties into the theme of new traders coming in, which is, and
all right,
people have all different types of backgrounds, so I think it fits that narrative really well. I find
all
it
right. Well,
inspirational.
I'll give you the high level. Basically, what happened in 1983, I believe was the date. A two very successful traders at the Chicago Board of Trade, named Richard Dennis and William Eckhart. They were partners. They had a little firm, and they had a little friendly bet against one another. There was no money involved, but they were just, or I shouldn't say it was a bet, it was a disagreement. Bill Eckhart claimed that the reason why his friend there was so successful was not because was because he was born with it, is what he was saying. William Eckhart was saying, you were born with it. That's why you were such a good trader. And Richard Dennis countered, said, no, I'm not born with anything. What I have, I could teach anybody. I could teach anyone off the street how to do this. Trading is not hard. And so they said, all right, well, let's put this to the test. And so what they did in 1983, or maybe it was 1982, they put ads in the paper, like in the Wall Street Journal, the Chicago Tribune, some other random places. And they solicited people from basically off the street to come in, and they will teach the guys how, their model. And long story short, they had thousands of applicants. They ended up selecting 20 people. These 20 people, maybe one of them had some kind of Wall Street experience, but the rest of them were, one guy was a former poker player, one guy was a dancer, one dude was an accountant, somebody worked in a restaurant. I mean, they were just people from all walks of life with no trading experience. And they brought these people into their office, and for 2 weeks, Richard Dennis basically taught them his strategy, the whole nuts and bolts. It was a rules-based strategy, and just 2 weeks. And then at the end of the 2 weeks, Richard Dennis and his partner, Bill Eckhart, gave each trader, I may have the numbers wrong, but I believe they gave them each $1 million account to trade. I mean, they didn't give them $1 million. It was just, $1 million account that they could trade. And long story short, over the course of like the next 5 years, these total novice traders, just following the rules that Bill Eckhart and Richard Dennis laid out, these traders made millions of dollars each. I mean, they had returns of like 100% returns every year. Again, I'm making the numbers up. I don't know what the exact numbers were, but they were remarkable. So they did so great that Richard Dennis and William Eckhart repeated it again next year. They brought in another crop of like 15 people off the street, taught them their rules, and again, fantastic success for all these people. And so I was telling the story about Jerry Parker. Jerry Parker was in that first cohort, that very first one. He was an accountant before he got into this. And, he's been one of these guys who went on to have great success and runs a CTA now called Chesapeake Capital. He's got hundreds of millions of capital under management. And when I started my hedge fund, I went online. I was totally DIY, did it myself. Like I didn't want to pay 50 grand or whatever it was to have a law firm put together all my documents and all this stuff so I could solicit investors. I was too cheap to do that. So I went online and I found people like Jerry Parker and a couple other firms. I found like their disclosure documents and their operating agreements and all these things. And I just basically plagiarized all their stuff into my documents, changing some of the things to be unique to me, but basically just copied and pasted all their stuff, particularly Jerry Parker's. So I had opportunity, actually, when you and I were both working at StockTwits, I had an opportunity to have him on a podcast that I was doing for StockTwits at the time. And I got to talk to him there, and that was great. Later on, we got an opportunity to meet in person, and we've talked on the phone a few times and over FaceTime ever since. And I just got to see him in New York just a few weeks ago. Actually, the same time I saw you, Stefan, that same trip. And it's just, to me, it was like, meeting a hero, right? Like one of my early heroes, one of my early inspirations. And the guy that really showed me that trend following is a very viable way to make money. And most importantly, what I liked about trend following, Stefan, is that it's not complicated. It's simple. The rules are simple. I mean, everyone's got different rules for trend following, but whatever rules you come up with, they're very simple. ways to identify trends, and there's very simple rules for risk management. There's very simple rules for exiting your trades when the trend is ended. And that, again, I'm a simpleton, and I love having simple rules to follow, and that's why I like trend following.
I have to say about the Jerry Parker thing, just to make sure I'm clear on it. So he is essentially comes in as a turtle trader, follows the rules because he's in sort of this contest or this test, whether people are born with great trading or if they can really just be given a system and have a chance to succeed. He's an accountant. He follows the rules perfectly. He stays disciplined. Kind of proves the test correctly, I guess, right? Does it kind of does prove the test? If you
Yeah.
have a system and follow it, you can succeed. And now he's a fund manager with hundreds of millions of dollars under management. Is that his story? That's
Oh yeah.
incredible.
Yeah, and it's amazing too, or an amazing quote that came out of that experiment from Richard Dennis later on when he was asked about that whole experiment. He said that, look, my rules are simple, and I could take out a full page ad in the Wall Street Journal and publish all my trading rules on one page. It's like 10 rules. It'd be very simple to follow. I could post my rules in the Wall Street Journal for the whole world to see, and I guarantee you very few people would match my success. And that's because people have a hard time following rules. People have a hard time sticking with it when the time gets hard, when you're in a drawdown. It comes down to psychology, and that was the real lesson. Was trading isn't hard. It's the mental part of trading that's hard. That's where people screw themselves up, and I'm certainly guilty of that for sure. It's not the rules that trip me up. It's or not the fault of the system. It's the operator, that this guy here, who's screwing everything up. And Richard Dennis nailed it with that quote.
I love that quote too, actually, because that does seem to separate a lot of great traders from maybe average or failed traders, which is you may have this great system in front of you. All you have to do is follow the system, but the constant, like, stimulation of the market or events or the noise or the drawdowns will eventually pull you away from that system. That's kind of maybe where things go wrong.
Yep.
On on that note, so now you're in commodities trading, and now going back to options, what are sort of the lessons that you've taken? One thing I think is really cool about your story is you've seen all corners of markets. You've seen equity trading in the dot-com bubble, you've seen commodities and trend following, and now especially options, which has been your specialty. What's sort of some of the lessons you've taken away from these different corners of markets? Because most people do tend to specialize maybe in one corner of the market, maybe don't do so well, then leave markets forever, or maybe they do too much and can't manage all of it. But I think that there's a lot to be said about seeing all corners of the markets and maybe fusing that into a discipline. So curious to hear if you have some sort of timeless lessons to share.
Well, the one thing I could definitely say, and I've learned this from trading all these different products, is that there is no one product that's the best product, right? Like, futures are not better than stocks. Stocks are not better than options. Options aren't better than cryptocurrencies. No product is the best. There is no best. The only product that is the best is what works for you and what you like to trade. And when I say product, I should broaden that out. Like, it relates to strategies as well, right? There's no one strategy that's the best strategy out there. It's the product and the strategy that makes sense for you, that you could wrap your head around, that excites you. It turns the gears and gets you thinking. It's a challenge for you. Because look, successful trading, I have learned, when I'm doing the best at trading, it's often when trading is the most boring. It sounds crazy, but yeah, it has to keep you interested, because if you're not interested, when you get bored, then you start, tinkering and making. And by the way, I'm guilty of this in spades. Okay, when I get bored, bad things happen. And so my advice to anyone is, find a product that is interesting to you for whatever reason. Find a strategy that is interesting for you for whatever reason, and zero in on that. But as far as having a best product, there is no best product. I have just come down to really enjoying trading options, because for me, options trading is like putting a puzzle together. There's lots of different ways I can express a bullish bet or a bearish bet or a sideways bet. There's a lot of different ways I could do it, a lot of different time frames I could use. And so to me, that's a stimulating puzzle that keeps me interested every day, keeps me waking up and excited for the opening bell every day. I was joking with one of my colleagues at All Star Charts about how because he slept in one day. He missed the opening bell. I think he might have been hungover. I'm not going to name any names, but he might have been hungover. And I told him, I said, you know what? I'll tell you, I've never missed an opening bell. There have been days where I've definitely felt like crap, or I was tired, or I was sick, or whatever. But when that opening bell rings every day, I'm there. I don't miss them unless I'm traveling or something, but that's a different scenario. But because I get up and I love to trade, I want to trade. It's very stimulating to me.
You know, I even find it hard to believe that you miss an opening bell while traveling, because I remember meeting you for lunch and you were on your computer following markets when I got there. So I feel like you're on it. But that is passion, and I do like the aspect too that you said. I just want to reiterate it because I see a lot of it about which products are better, especially maybe how cryptocurrency traders or stock traders go at each other. And I just think it's very interesting to be reminded that actually there really is no winner or no way to prove it. It's more about exactly what you said, what fits your needs or what your goals are or what you are trying to accomplish. So it's a cool message, and just wanted to reiterate it because I do like hearing that.
Yeah, and I said this to somebody recently. I run a traders meetup group here in Colorado where we get together twice a month with traders, and I get new traders, I get old traders, people who've been around forever, people who've traded everything, get all kinds of traders. But I was talking to this one kid, and I said, "Look, this might sound controversial to you," because he was relatively new and he was having a hard time with it. And I said, "Listen, man, trading is easy. Being a trader is hard. There's a very big difference. Trading is just, it's the X's and O's. It's following the game plan. It's like, a football player, right? You sketch out the X's and O's, and you sketch the plan or the play, and you just do it. As Bill or William Eckhart and Richard Dennis proved, you just need a handful of rules and then go, right? And you can learn that quickly. You can learn that in a week, right? The X's and O's of buying and selling stocks or options or commodities or whatever is pretty easy once you spend a few minutes or a few hours or a few days focus on it. So trading is easy. Being a trader is damn hard, because you think you're battling the market, you think you're battling other market participants. No, you're not battling any of that stuff. You're battling yourself. And that's the toughest opponent you'll ever face.
So that is so awesome to hear, especially because let's say maybe I'm on Instagram or TikTok and someone posts a video about how they're a trader and they're getting on their private jet or in their Lamborghini, and it's like this whole image that trading is glorious and it's so easy. And but really it's kind of a theme I'm finding as I talk to real traders. People have been doing this for a long period of time. It tends to go, it's not like that. It's much more difficult and or boring, which I thought was a cool comment. Trading's boring. Why is that? Because if you're doing it really well, you're sort of just sitting on your hands, being patient. What's the thesis behind that line?
Well, if you're trading well, it's probably because you're following a system. And when you're following a system, you're just like, when X happens, you do Y. When A happens, you do B. It's like there's no real mental challenge that goes into it. You're just a monkey following instructions. So that part is boring. You can't find excitement in that. You got to find excitement in other things. Maybe in coming up with new strategies, maybe researching, maybe back testing, maybe trying different time frames or different products. There's other ways to entertain yourself, but the actual physical act of trading, and I say physical, it's not like we're swinging hammers over here, but hitting the buttons and executing the trades, that should be pretty boring, pretty rote. And by the way, I'm guilty of this, Stefan, all the time. Like if you find yourself hitting keys and getting real emotional and getting super excited when you're making money and getting super depressed when you're losing money, you're probably doing it wrong. You should probably take a step back and be like, hey, what's happening here? I'm about to, I'm at risk of really hurting myself here. And I've gotten better at that over the years. My wife has commented that she can rarely tell what kind of day I've had in the market, which is good. That wasn't always the case, but she's like, I can't tell if you made money or lost money today, and I'm not even going to ask. I'm like, great, let's keep it that way.
That I hope people who are listening to this, press rewind and listen to that a few times, because that actually that hits me, because I find it to be a very powerful statement. I think maybe it ties to stoicism to some degree, and I have to say that that's oftentimes when I talk to new traders, and it tends to be a theme, just especially markets back in 2020, 2021, how many new traders that brought in, which I want to talk to. I wrote down a note here that I have to bring that up before we get off. But back to the stoicism line, I find that when people are bragging about their trades, sometimes that's a red flag, because this game goes on for a long time, and just as quickly as you might have a few gains, you might have a few losses. So are you inspired by stoicism? Is that where that comes from?
Not only am I inspired by stoicism, but right here on my desk, there's my daily stoic. I don't know if you can read that. It might be backwards, but I've got it right here on my desk. I refer to it every day. I try to be a practicing stoic. I'm not the best at it, of course, but I find that is very useful, particularly for traders, right? I mean, we have to find a way to divorce our emotions and our self-worth from what we do in the markets every day, because we can't control the markets. We can't control what happens. We can't control the winning trades. We can't control the losing trades. All we can control is how we react to them, how we execute our plan, and how we manage our risk. That's all we can control. And I feel like the tenets of stoicism really drive that home about focusing on what we can control and ignoring the rest, or at least not giving it so much energy, so to speak. So I'm a very big fan of stoicism, and I wish I was better at it, but it should always be a work in progress.
So we're coming up on an hour, and I don't want to keep you, too long. And I have, though, a few things I have to ask you related to our conversation that hopefully other people were thinking, and maybe they'll get their answers based on these few questions. So we talked about the dot-com bubble, and one thing you had me thinking about was actually the 2020 to 2022 rise with Zoom and Teladoc and some of these other names. And along those lines, I was thinking that while you're watching that moment happen, are you able to draw from that experience in the dot-com bubble to maybe be a little more prepared for these maniacal moments? For those who aren't watching, I've had a chart up of Zoom for the last few minutes, because I think the chart encapsulates kind of a maniacal moment, and even this kind of mania breaks that stoic mindset. So curious what you thought of that run up, and if these experiences, for those who just experienced something maybe similar to the dot-com bubble, those people listening can use that experience to better themselves a little bit in the future.
Well, that Zoom chart, first of all, that is what a lot of charts looked like during the dot-com bubble. That's a great example, right? Zoom did it. It had the dot-com bubble type move. Now just imagine 500 other stocks that look just like that. That's what the dot-com bubble was like. Yeah, I mean, the thing about the mania moves like that is that, or at least from my experience and what I learned, is that more so than any time ever, that's when you really have to be mindful of your risk management. Risk management is the only thing that's going to keep you in your game. When you see charts like that, it's very easy to think about all the money you're going to make if you catch that run from $200 a share to $500 a share, right? You see that and you're like, oh, that's easy, just buy and hold, right? Well, no, it's not easy. And you have to be thinking risk management first, and maybe first risk management only. Let the wins play out. Let them do what they need to do. They'll win without you. But you have to, size your position properly. You honor your stop losses. You got to have a plan when things don't go well. Like, for example, and I should point out that as crazy as the dot-com bubble was, and as rapidly as stocks rose, even during the time when the bubble was still inflating, the traders in my office, we always had our best days when stocks were going down. we were making money on the short side. Even like in that area you've got highlighted in green right there in that zoom, if that was, during the time when I was day trading in that office, I guarantee you that most of the traders in my office made money trading that stock, and they probably made money on the short side. It might be counterintuitive, but stocks just they tend to go down faster than they go up, even though it doesn't look like it on that chart. But on a stock like that, if it's very tempting to want to short a big move, right? And that's how people can really get hurt if you're not, sizing your positions properly and exiting when you need to exit according to your plan, because it's very easy to get your face ripped off in a move like that if you're caught on the wrong side.
And the aspect of shorting as well, and placing these types of trades. This was the next question that I'd written down, and brings us back to options just a little bit. Was options and going short or planning short trades. I'm not recommending short trades at all, of course. This is just me just working through.
Why not? Come on, let's get short.
Well, this is kind of we would have to discuss the just how much you can lose going. I mean, you want to be covered in some respect, have that risk defined. But it takes me to options, which I find, and correct me if I'm wrong, and it was something I was thinking about why we were talking about options, and especially now that you mentioned going short on moves like the dot-com bubble crash or the Zoom chart. With options, you can go short with defined risk, whereas if you're short stock naked, I don't really know, unless you have a stop loss, I'm not even sure how you're totally defined. But maybe just provide more insight on that aspect.
You're not defined.
Options.
If you're short stock, let's say on Zoom in this chart here, we're looking at June of 2020, right? And you're like, okay, Zoom's at $200 a share. That's way too much. I'm going to get short. Okay. And you might have a stop loss at 210 or 220, right? Actually, let's zoom in on that date right there. I think it's in August, right before that big gap. See, right, is that like the last day of August, I think? Yeah, right there. Okay, so on that green candle day, the thing ripped up. It's trading at about what, $300 a share. You can come into near the end of the trading day and say, that's too much. I'm going to short that thing, but I'm going to be really smart about it. I'm going to short it at $300. I'm going to have a stop loss at 320. Okay, great. Well, look what happened the next day. Stock gaps higher, $150 in your face. No stop loss in the world is going to protect you in that situation. You just got totally screwed. Now, I brought that up because this is where options can shine. If I was equally bearish, but instead of shorting stock, I bought a put, what would have ended up happening is that, yeah, the stock gapped higher, but my put was defined. The most I could lose was whatever I paid for that put. And the put buyer performed dramatically better in that scenario than the guy who got short stock. The guy who got short stock probably got his face ripped off. It had a loss that ruined his month, if not his year. Whereas the guy that bought puts, hopefully he sized his position in a way that he lost money. And it's just like any other loss. That sucks, but hey, wipe it off and move on, right? So that's one thing that puts can offer in a parabolic move. It's a better way to try to play the mean reversion. Now, in a move like that, I don't have the prices in front of me, but oftentimes option premiums will get a little bit elevated in situations like that, right? Because stocks are moving wildly. When that happens, options premiums tend to go up. So it might be a little bit more expensive to buy those puts, but you can't put a price on a peace of mind in situations like that.
The example of this gap up is perfect because, yes, you could have the most perfect stop ever, or you think you have the most perfect stop ever, but because of the gap up, you wake up and it, destroyed, really.
Yeah.
So
you're waking up to a very unfriendly margin call from your broker.
Exactly.
That's what's waking you up in the morning. Not your alarm, but the phone ringing.
It's a fascinating aspect, actually, of going short equities and maybe other instruments, even if you're shorting crypto or maybe Forex. If you're just doing it with the underlying, asset or share price, your risk is not defined all that greatly. So really interesting to think about. And that was the final question that I had written down. I know we're hitting that hour marker. Sean, really nice to have you on the show. But before we head out, any final words that you want to leave our listeners with? And imagine that there are new traders from all around the globe potentially hopping into this chat, or experienced traders who maybe need to be reminded of something. Leave them with some parting wisdom.
My parting wisdom would be this: if you, especially if you're new to trading, the way you get from point A to point B, point A being brand new and not knowing what I'm doing, to point B being a successful trader, the way you get from here to there is not by being the smartest guy in the world or smartest girl in the world. It's not by finding the holy grail strategy. It's none of that. What it is time. You have to put time in. You have to experience things. You have to make mistakes. You have to lose money. You have to do every dumb thing that you can possibly do, and you have to survive it. That's the important thing. And the only way you get from here to here in time is by surviving. And the only way you survive is by not taking huge losses. You have to trade small. You have to define your risks. You have to trade in a way that no matter what happens, if you get blown out on any particular trade, it's not going to ruin your account. It's not going to ruin your career. The trades have to be small enough that you can come back and fight another day, because that's the only way that you could put the time in. It's the only way. You got to have your ass in the seat for hours and hours and hours, and you got to have your ass on the line. You got to make mistakes, and that's the only way to succeed. And it's hard and it's painful, and that's why people don't always make it, because it takes commitment, it takes time, and it's not always going to be easy. And even if you're successful, you're still going to have those days or those weeks or those months where you give money back. And it's hard to explain to somebody who doesn't work in the trading business. It's hard to explain to somebody who has a 9-to-5 job that, hey, I worked this month and I actually lost money. I went to work every day and I lost money. Like, no one who works a 9-to-5 job can relate to that, right? They get their paycheck and whatever. But you just got to put in the time, and there's no holy grail, and there's no magic sauce. There's no magic product or strategy. It's just, you got to learn how to manage yourself and learn how to manage your risk, and just do whatever you can to make sure that you're still able to come back and play the next day.
Awesome parting wisdom. And for those who are listening, you can follow Sean on Twitter. He's on TradingView. He's on YouTube. I don't think I missed anything else. He runs a blog and a great email newsletter. I believe you can just type in Sean McLaughlin All-Star Charts or OptionsSean. Follow him, interact with his work, send him a message. He's online, he answers. I read his email quite a bit, and sometimes I send him, great newsletter, Sean, and he responds. So he's out there reading everything. So thanks to everyone for watching, and Sean, thanks for hopping on.
Stefan, always great to see you, buddy. I miss working together. Those were good times back in the day.
Awesome times. I know. I almost wanted, before we did our show, I don't want to take us on another tangent, just want to say this. I almost wanted to do an episode with you about mentors, because I think that's another interesting topic in trading and investing. Maybe another show in the future, but
maybe next time.
Yeah, exactly. Okay, Sean, I'll see you.
All right, see you, bud.